lot of people say, well, I want a second fund and I want it to be American. Well, all right, that's going to introduce us to our next two, and we're going to stick with Vanguard for the moment. There are others, iShares, and a lot of different companies that own indexes, but I want to look at VTI versus VTSAX. And what we're going to do is we're going to compare a few things. We're going to compare the minimum. We're going to compare the expense ratio, that 0.08. We're going to compare the price, automation, investments, and dividend, and what you own and how it's taxed. So as you look at these two, these are the United States index. So these are going to be, as you see, 9,000. These are going to be 3,500, around there. Again, these are not precise numbers, but these are good generalizations. Of 3,500 companies in the United States, you can own with just one single purchase. That is VTI and VTSAX. What the difference between these two is, VTI is a exchange traded fund and VTSAX is a mutual fund. Now, for the average investor, you really don't need to know too much of the discrepancies between these. And I'm going to show to you right now how similar they really are. But if you were to say, love it, Jed, I'm going to go get some VT. Awesome. I want a second fund, and I'm going to start buying some of that to tilt and favor my portfolio towards the United States. Well, here's where we're going to be at. So, how to buy into these? $3,000. That is the minimum investment for that mutual fund. Mutual funds have a higher minimum, and we're going to explain here why in a second. This minimum is one share, which on average is around about $150, I believe, right now. Let's see. Yeah, about $150 right now to get one share. So this is to buy 3,500 companies in the United States in an ETF or in a mutual fund. You can buy it at one share for $150 or VTSAX for $3,000. Now, what is the difference? Oddly enough, if you were to look at the expense ratios, 0.04, 0.04. That's half. This is already an absurdly low fee. And do they have funds today with no expense ratio? Yes. Fees are being driven down because of the global climate. So as you look at it, they're charging the exact same. And I want to look at something else, this investment part. They invest in the same thing. It's the same $30,500. They provide the same dividend, which is dividends, interest, or the money that is being paid for you investing into this fund. Where the difference becomes is in a little bit of the features. So when do they price it? This is priced just like a stock. This is priced end of day. So this is one of the big discrepancies between a mutual fund and an exchange traded fund. Mutual funds actually own part of the company. They own part of the stock. Exchange traded funds own more of a unit. They own a example or an estimate of what that stock would intake. So they trade like a stock because they own units, not the security or stock. Okay, so mutual fund owns the underlying company, owns the actual stock, Whereas exchange traded funds own more, they call them units, and they are not the actual underlying security. That's going to come back into play here in a second. When you look at the pricing, they only can price it at the end of the day because they have to look at where all of those companies ended up. This one, because it's not precise, it's an estimate, can trade like a stock throughout the day. It's, 9:30, I can go buy ETF. It's 12:30, I can go buy ETF. I can go buy these throughout the day, but you don't get the price until the end of the day. So that's a unique situation there. The automation part, this is a big feature. Can I systematically set up $100 a month into a mutual fund? Yes. Can I systematically sell a mutual fund? Yes. Automation in an ETF, a lot harder. They don't allow it, at least in most of the bigger brokerages. So looking at that, you will be able to see that is a feature. If I wanted to set up an automatic investment, I would want to go with the mutual fund. If I wanted to be able to buy and sell it throughout the day, I'd go with an exchange traded fund. Now, if you're looking at taxes, this is going to be a little more taxy. Ooh, that's probably going to be misleading. It's not more taxes. Efficient, not as much. Because you own the actual stock, capital gains, which we can talk about, capital gains gets traded as you look at the exchanges. So things go up, things go down, we're exchanging as the manager. Because we're actually trading the actual security, you get charged capital gains in a mutual fund. Because you're only owning units and you're not actually owning the security or the stock, it's going to be more efficient because a exchange traded fund, an ETF, can mitigate or lower your capital gains tax. So this is a big, complex view of what the fundamental difference between an ETF and a mutual fund is using the index of the United States 3,500. Ultimately, which one should you buy? For the average investor, really doesn't matter. Sorry to go through all this to tell you that. But looking at it, you really have to say, do I want automation? Yes. Do I want a little more tax efficiency? Yes. Do I want to be able to trade it like a stock? Nah. Do I want to have a higher investment minimum? There you go. So this would be the second. If I looked at this as my first, this would be the second fund I would be comfortable buying and putting in my portfolio and starting to build it out.